First on, let me say thank you so much for attending this webinar, and I cannot express how grateful I am with your great feedback after the last webinar. As always, I really hope you find this webinar worth your while. We have a lot to cover today, so let's see what this webinar is all about. In this third and final part of our webinar series, we are going to explore the world of technical analysis. In the past two webinars, we went through trading psychology and how trading psychology is the most important factor in trading. In the second webinar, we went through money management techniques and their advantages and disadvantages. If trading psychology is the framework within which we trade, and money management is the filter through which we find low-risk trades, then technical analysis is the decision-making toolkit that tells us when and where a high-probability trade is likely to take place. In this webinar, we are going to talk about the logical steps of building a convenient trading system that works. Then, I will share with you 3 powerful technical tools that deserve a prominent place in your trading arsenal. Even though these 3 tools are powerful technical tools, they should never replace your existing technical system. Rather, for greatest benefit and impact, they should be used as a confirmation method alongside your technical system. You will find that I will stress on this point repeatedly throughout this webinar because simply we should never throw away what we have learned in favor of a new technique. Rather, we should learn to get the best out of the 2 techniques. Whenever we are about to build a trading system, we should keep the following steps in mind. These steps ensure that we do build a convenient trading system that works in our favor. The first step is a very easy one, which is coming up with a concept. A concept is a technique, an indicator, or even a pattern that promises a theoretical high probability of success. Okay, can you hear me louder now? Great. So I was saying that a concept is a technique, an indicator, or even a pattern that promises a theoretical high probability of success. To come up with a new concept, we have to expose ourselves to new information, like reading a book that provides us with a new tool, or attending webinars, or attending traders meetings where we can exchange information regarding different technical tools. Once we have a promising concept, we can start by researching that concept, figuring out its common uses, what other traders' feedback is regarding that concept. If we see promising results, then we should move forward to the next step. The next step is initial identification of opportunities. What we want to achieve by the end of this step is just a proof of concept, a confirmation that we are on the right track. It is time to test the waters. This is the first practical stage where we try to check if the concept we have can render the results we want. Start by applying initial entry and exit rules according to what you learned about the concept you plan on using. Now we will start our initial paper trading, and there is absolutely no need to do full backtesting at this stage. All we need to do is confirm a positive feedback. If results are positive, then we should move forward to the next step. The next step is developing our own trading system is to settle on a confirmatory method. This step is the most important step, as this step can dramatically enhance our concept and its profitability. If you remember, we talked about confirmation points at length in the first part of this webinar series, and how confirmation tools can be used as an entry point. Confirmation method should be simple because a complicated confirmation method would take a lot of preparation time and might delay our entry, resulting in less profit. Confirmation method and our technical system should not be of the same type, and by that I mean That technical system we use, if that if the technical system we use depends on lagging indicator like a MACD or moving average or Bollinger Bands, then confirmation point should be based on a different type of technical analysis. And we will soon discuss 3 tools which can play that confirmation role. The next step is shaping and developing a strategy or making decisions. Once we settle on confirmation method, we should start the next step, which is shaping and developing a strategy. This is where we make most of our technical decisions. First, can the concept work with different instruments, or is it tailored for a specific instrument? Then, what time frame yields the best results? Or is that concept independent of time frame limitations? Then, if we agree on using confirmation method as an entry point, how would we exit a trade? Should we exit the market when we receive a new signal or when another criterion is met? Once we are done with entry and exit rules, it's time to work on our money management. We covered different types of money management techniques in the last webinar, and I think we have a solid base in money management by now. By now, we probably cannot wait to use our trading system, but if we want a really efficient system, we have to go through 2 more steps. You probably can tell already that we still have to run backtest on our trading system. We have to make sure that the boat we built can float and would not sink once in the water. We have put so much time and effort into our trading system by this stage, but it is entirely possible that we overlooked an important aspect of the system that we need to focus on. This step is divided into 2 processes, backtesting and live performance forward testing. Backtesting gives us the opportunity to make sure that our trading systems work as it should. If you do not know how to run a backtest or having problem coding a backtest, it's okay, you can still do paper trading. The most important point about paper trading is recording. We have to record the trade time and entry, stop loss and take profit point, and of course record the results of each trade. If we were unsure about a decision we made in the last step, like if we were not sure whether we should trade on a 15-minute chart or a 1-hour chart, running a backtest or paper trading on both time frames can give us a chance to compare results and use what is more suitable for our trading system. In essence, this stage is where we fine-tune our trading system to get the results we want, or at least get as much close to these results as we can. As we all know, every Forex disclaimer out there states that past performance is not indicative of future results. In other words, yielding positive results during a backtest does not guarantee a successful trading system. Therefore, we have to start doing our forward testing on a demo account. This is the last stage before going live and trading our own hard-earned money in the Forex market. Even though backtesting is vital and essential for the development of our trading system, backtesting has a number of inherent problems. For example, the structure of our broker's historical data. This is why we are running our forward test on a demo account first. Forward testing is no different than real-life trading, except that we are yet to introduce our money. This smooth transition from backtesting, then forward testing, and finally live trading has its psychological benefits, as it increases our confidence in the system as we move on each of these stages. The last step is an ongoing step, which is called optimization and enhancement. We have to keep in mind that no trading system is perfect. Therefore, we can always increase the profitability and performance of our system as we gather new information about trading. The key point here is paying attention to our losing trades and studying them. Why did the trade fail? How to avoid that loss in the future? Okay, if avoiding that loss is not possible, how would we minimize risk and loss? Do we exit trades early and leave money on the table? then we should start by reconsidering our exit strategy and think of a better way to exit our trades and so on. With that, the steps are concluded and we should move on to our 3 technical tools that we are going to cover today. The first technical tool is called point and figure charting technique. When I started trading, I had a nagging question at the back of my head. Whenever I asked that question, I got no satisfying answer. But before asking you that question, let's first agree that most technical tools we use today were developed back when trading was allowed for certain hours of the day. Between 6 and 9 hours of trading a day, depending on where you live. That resulted in a condensed buying and selling signals as we were not allowed to open or close positions once the market is closed. But with the introduction of 20 hours a day trading, time created anomalies, with low volume and slow hours trading since there's no rush to open or close a position. That amount of time created distortion on price charts with longer hours of inactivity. In other words, this means that a pattern which used to be clear in the 60s would not be as clear on our charts and it would not be as accurate. That distortion surely affected the tools that we use today as it was essentially designed to work with certain hour system. As an example, if you have been trading for a number of years, have you noticed a decrease in the accuracy of candlesticks pattern? We all know that pure price action is the most powerful indicator, and any other indicators lags behind price action. So to solve this distortion issue, we have to take one of 2 routes. Either we extract price action from our chart without the time axis just to make sure that time is not affecting price action, or we make sure that the technical tools we are using are time independent. Of course, we can still resort to trading in a stock exchange that works only for certain hours a day, but for me, that was not a viable option. 2 of the 3 tools I'm going to cover today handle these issues. So let's start by looking at point and figure charts. Point and figure chart is an old charting technique that was used over a century ago before the widespread of candlesticks chart. It's not known who created that charting technique, but one thing to be sure of is that this charting technique is very, very powerful, yet it is almost non-existent and only professional traders know of it and apply it. It's almost non-existent to the point that author Jeremy Duplessis said, point and figure charts are one of the great secrets of the technical analysis world. There are a number of types of point and figure charts, but this chart is the most known and typical point and figure chart, and it's called 3-box reversal method. The first thing you notice is how simple and elegant this chart is. This is the British pound US dollar, by the way. So the chart looks great and simple, but we still do not know how to read it and why we go through all that trouble in the first place to read it. I will answer both questions in order. First, how to read point and figure charts. If you assume that the green letter X represents upward movement and the red letter O represents downwards movement, then you would be absolutely correct. By the way, all point and figure charts are courtesy of Owanda Corporation. Each X or O is called a box. So, in other words, each small square in this grid is called a box, and it represents a number of pips that we can change at our leisure. In this chart, every box represents 40 pips. So, to draw another X here, we need price to move up by 40 pips. It doesn't really matter if price moved up by 40 pips in the next 5 minutes or in the next 5 hours. If price moved up by 40 pips, we draw another X. If price moved up 39 pips and reverse directions, then we do not get to draw another X. By now, you can see why point and figure charts are time independent. If we choose to change the value of each X or O from 40 pips to 10 pips, then we will be looking at a shorter term trading period. But if we change that 40 pips value to 100 pips value, then we will be viewing a longer term period, which, for example, would be equivalent to a monthly candlestick chart. I already mentioned that this point and figure chart is drawn using the 3-box reversal method. So why was it given that name? Hi, Robin. Well, I'm glad that I can see familiar, I would like to say faces, but I can see familiar names here. Thank you so much, guys, for your support. And yeah, it's a bit like Renko. So, why this method was called 3-box reversal method? It was given that name because for a trend change, we need price to travel the distance of 3 boxes before we draw that reversal. So, let me explain. In this chart, if price moved down by 40 pips, we do not get to draw that letter O here, but we have to wait for price to travel the distance of 3 boxes, which means 40 pips by 3 boxes, which equal 120 pips. So when price moved down by 120 pips, we draw 3 O's in the next column. If price continued moving toward the downside by 40 pips, then we draw another O. Let me assure you that all of the drawing is done automatically for you, and you do not actually get to draw each box yourself. Since we have limited time today and we still have a lot to cover, I should jump now to one great aspect of point and figure charts, which are the powerful patterns which generate buy and sell signals. I will quickly go through 2 buy and sell signals with real-world examples to illustrate them as best as I can. The first pattern is triple top and bottom pattern. In the triple top pattern, price starts by attempting to move toward the upside, but is faced with resistance and it reverses direction toward the downside before attempting one more time to break that resistance level, and for the second time it fails and moves toward the downside. This creates a resistance line, and when that line is broken on the third attempt toward the upside, it creates a substantial move. The same applies to the triple bottom pattern. And now let's see a real-world example of a triple bottom pattern on Euro USD chart. We can see that price attempted to move toward the downside, but was faced with a support area at the horizontal red line level. And so it reversed directions toward the upside before attempting for the second time to break that support. Yet, once again, it fails to break below that line. When we see price reaches that same level for the third time, we draw the red support line. If Euro USD managed to break below that line by 1 box, that would be our sell signal. Now, let's see how Euro USD behaved following this selling signal. A very, very profitable pattern. But let me remind you that we are only using point and figure chart as a confirmation method. So we would only enter this trade if our trading system gave us a selling signal and then it was confirmed by a point and figure pattern. Now let's view the second and last pattern, which is triangle. In this particular type of triangle patterns, we see a sloping top and a sloping bottom. This specific pattern suggests market uncertainty. Really sharp, Robin. The numbers represents month. So 1 for January, 2 for February, 3 for March, and A for October, B for November, and C for December. It's just a visual representation so you can get a feel of the time passing by as as point and figure charts does not represent time at all. There is no time axis here horizontally. So back to triangles. In this particular type of triangle patterns, we see a sloping top and a sloping bottom. This specific pattern, as I said, suggests market uncertainty, that bulls and bears are fighting for control, but neither is winning. So we wait for 2 points to take place to enter the market. First, we wait for a break of the sloping trend line either toward the upside or toward the downside. The second point we wait for, and the most important point, is a breach of the previous column. Once the 2 points were met, we can enter the market. Let's view an example of this pattern for Euro-USD dollar. In this chart, we can see the two sloping trend lines and how price started to be locked in a tight range. Our first objective here is to see a break of either sloping trend lines. And once we have that, we turn our focus to the second point, which is a breach of the previous column here. Once that letter O is drawn, we wait for a breach of the previous column to get our signal to sell the market. Now, let's see how price did unfold after breaking below that point. When I was preparing this webinar, I prepared the charts for a third pattern, which is called 3-box catapult pattern. But unfortunately, I had to skip that pattern in preparation in order to give time to the rest of the topics we are going to cover. The next tool we are going to discuss is Fibonacci and Elliott wave analysis. I know many of us believe that Elliott wave analysis is a complex form of technical analysis, but reality is, Elliott wave analysis is one of the most accurate forms of technical analysis, and the whole theory is based on 3 simple rules. Before we get to these rules, let me present a chart to show how accurate Elliott wave analysis can be. This chart is a 3-day chart from March 2013 till the present day. I chose that date because that was the first date when we started contributing to FX Street. You see that I added the dates next to each high and low to make it easier to verify the numbers once you go to FX Street. Well, Robin, actually, point and figure charts have target projections and stop loss placement, but that topic is a big topic, and I actually plan on presenting a webinar regarding point and figure charts. So hold on tight. So back to this Elliott wave chart. You see that I added the dates next to each high and low to make it easier to verify the numbers once you go to fxstreet.com. The other 2 numbers are how accurate the target was in pips. For example, here on February 3rd, 2014, you can see that we anticipated a low 1 day in advance, and target was reached and exceeded by 31 pips before reversing directions. I have to mention again that I am not saying that you should get rid of your trading system to use a trading system based on point and figure charts or Elliott wave analysis. To the contrary, both techniques can be used as the framework where you apply your trading system and can be used to confirm the signals that your trading system provides, and therefore you would get the maximum profit and impact for your trading. Now, let's move on to the typical look of Elliott wave analysis. In essence, Ralph Nelson Elliott noticed that market always move in steps. So he suggested, based on human psychology, that markets move 5 steps in the direction of the trend and 3 steps against the trend. He also noted this pattern of 5s and 3s is fractal in nature. meaning that it keeps repeating across all time frames. So you can see the 5-3 pattern on a monthly chart and still see the same pattern on a much smaller scale on a 1-minute chart. Let's do a quick poll here. How many of you guys have used Fibonacci ratios before, either retracement or expansion? Did you find it useful? Did it yield any great practical results? I really am glad to hear. Ralph Nelson Elliott was among the first to apply the Fibonacci ratios, and by the way, thank you so much, Robin, for your feedback. Was among the first to apply the Fibonacci ratios to the stock market with great success. He used the ratio to calculate where a certain wave would be likely complete. Let's take a quick look on how he suggested to use Fibonacci ratios. Second waves should retrace 61.8% of first waves. Third waves expand by 161% of first waves, while fourth waves retrace 38% of the third waves, and finally, fifth waves tend toward 100% or equality with first waves. Don't worry about these numbers. We will go through practical examples right away. Here is an example from British pound US dollar pair to show how accurate this ratio can be. This is a 5-minute chart, and it took me about 5 minutes to scan for this wave pattern. That we are going to see as an example. This is how in abundance Elliott wave patterns can be. Elliott expected wave 2 to end around the 61.8% ratio of wave 1. So we should expect price to drop to this level before starting the next upwards phase. So the ratio for the second wave is here, and you can see that price reversed direction exactly at that level. So this was the ratio for the second waves. What about third waves? He suggested that third waves should typically expand by 161.8% the length of first waves, as shown in this illustration. That expansion is added to the low of second waves here. If I can find the mouse here, to present a projection for the completion of a third wave. Let's see how price unfolded in regards to the projected targets. If you have been following me so far, you know that according to Elliott, we should see a drop toward the downside to complete wave 4 before moving toward the upside again to complete the fifth wave. Using the traditional wrong application of Fibonacci ratio, we would apply the Fibonacci ratio from the swing low down here. Typically, we would expect price to retrace toward that golden ratio at 61.8%. So by using traditional application, we should expect price to reach this level here. Let's see what Elliott expected this wave to reach. Elliott stated that fourth wave retraced 38.2% of the previous third wave. This is an important differentiation. We do not calculate the Fibonacci ratio from the end of the swing low here, but from the end of the second wave. And instead of reaching 61.8% around here, Elliott expected the fourth wave to end at 38.2% around here. So we should anticipate a shallow retracement. Let's see how price unfolds from there. I hope you can see by now how powerful Elliott wave analysis is and how powerful it is to apply Fibonacci ratio to Elliott wave analysis instead of the traditional application of swing highs and swing lows. Another very common ratio is 100% or equality. This ratio is found between waves 1 and 5. Elliott states that fifth waves are likely to find resistance when it expands by 100%, the length of the first wave. So if this first wave was 20 pips long, then we should expect a fifth wave to be roughly around 20 pips long as well. So to continue with our example, we should expect wave 5 to travel the same distance traveled by wave 1. I just want you to imagine how powerful it is to have such an accurate tool in your trading arsenal, alongside your existing trading system. Now we will move on to the final and third tool we are going to cover today, which is MACD indicator. MACD stands for Moving Average Convergence Divergence. This indicator was developed by Gerald Appel, and I view this tool as the Forex Swiss Army knife multi-tool. There are many useful uses for MACD. I have to say that I usually do not use indicators on my charts. My primary trading tools are Elliott wave analysis, followed by trend lines, MACD, and point and figure charts at the end. These are my primary tools. If I come across a candlestick pattern that confirms or refutes a signal, then I keep note of it, but I do not depend on candlesticks pattern because I noticed a significant drop in candlesticks pattern accuracy in the Forex market. Back to MACD. Why does MACD work in the Forex market? No one can answer that question with certainty. So I will give you my humble opinion, and please let me know your opinion if you have thought about that same question before. We can argue all we want about MACD mathematical formulas and how effective they are. But one thing I believe is true is that MACD became a very well-known indicator that it became a self-fulfilling prophecy. We will cover this point once we go through MACD different uses. First, let's start by identifying MACD different components with its standard settings. Keep in mind that how the lines are calculated is not that important for us traders, as every trading package do that automatically for us. The first line is the MACD proper or the MACD line. The black line on this chart, which is the 12-day exponential moving average, less the 26-day exponential moving average. The second line is represented by a red line, which is the signal line. This is the 9-day exponential moving average of the MACD proper. Next, we have the histogram, which is the difference between MACD proper line and the signal line. Finally, we have this zero line, which is called the center line. There are three typical uses and lots of information to be extracted from MACD. This is why it resembles the Swiss Army knife with its multi-tools. I will mention one more time that this indicator can never be used standalone as a trading strategy. However, it's best used as a confirmation method. Let's start from the weak signal to the strong signals. The first signal we are going to discuss is signal line crossover. This is the first weak signal, and it's considered a signal when the signal line crosses above or below the MACD line. If the signal line crosses upwards, then it's considered a bullish signal. If that signal line crosses toward the downside, then it's considered a bearish signal. The best use for this technique is that it should only be used in trending markets and only with the trend and never be used against the trend. Once your trading system suggests a trading opportunity, you wait for the signal line crossover to happen to enter the market. As you can tell on this chart, that signal line crossover happened quite a lot, and even though most of the signal line crossover provided us with good opportunities, we had a few false signals. This is why it's essential to use this technique only as a confirmation method. The next signal we are going to discuss is called center line crossover. This technique is generally stronger than signal line crossover to a certain extent. However, it really is lagging, and it takes place when MACD line crosses above or below the center line. That usually results in a confirmation of the trend, because it suggests that underlying pressure exists and also that pressure is capable of pushing price action. This is the same chart that resulted in the previous signal. The first thing we can notice is that center line crossovers are less frequent than signal line crossover, but to some extent, center line crossovers are more reliable. It's evident from this chart how lagging center line crossovers are. They do not take place until a trend is established, and they serve to confirm the trend, not to expect a trend reversal. We would need the third and most important use of MACD, which is MACD divergence. This is the best use for MACD. More often than not, you are likely to find a MACD divergence before any sizable trend reversal. There are two types of divergences: regular divergences and hidden divergences. Before jumping to MACD divergence type, we have to know what a divergence is. Most of the time, price and momentum move hand in hand. When we see price making a new high, MACD follow by making a new high. The same applies when price market make a new low. MACD follow and make a new low in the readings under the chart. A divergence is when price and MACD have a conflict and differ from each other. First, regular divergences. A regular divergence is when price creates a higher high and MACD fails to reflect that action and fail to create a new high. The same applies when price creates a lower low and MACD fails to create a lower low. Regular divergences usually signal trend reversals. This is an important differentiation between regular divergences and hidden divergences. Regular divergence signals trend reversal, while hidden divergence, as we will see, signals trend continuation. Let's see an example to clarify the regular divergence. In this example, we can see that price made a new low, but MACD at the bottom of the chart failed to create a lower low, and yet it created a higher low. This is considered regular divergence. Please notice how price action unfolded following that regular divergence. As price kept moving up, we notice another divergence is unfolding on the chart. When price continued to make a new high while MACD failed to reflect price action and failed to make a new high. This also is a type of a regular divergence. So to sum it up, a regular divergence is when price make a new extreme and MACD fail to follow. Now let's move on to hidden divergences. A hidden divergence is the opposite of regular divergence. In this case, MACD made an extreme reading while price fails to reflect that extreme. So in regular divergence, MACD failed to do an extreme while price do the extreme. In hidden divergences, MACD is the one doing the extremes and price, acting normally, failing to reflect that extreme. So in uptrend, we see price making a higher low while MACD continue to make an extreme reading. This should signal trend continuation toward the upside. In a downtrend, we see price making a lower high while MACD continue to make an extreme reading. Let's view this example to see a hidden divergence in action. we can see that the trend is moving up. Price is making higher lows, and if we look at the bottom of the chart, we can easily see that MACD is not following price action, and that MACD is creating an extreme reading while price kept toward the upside, and it even did not make a new low. This should tell us that the uptrend is about to continue and that we should remain with the trend. One last thing, this is all from me today, and I really hope this webinar was helpful and that it was worth your while. I guess this is the first time we wrap it up before the 45 minutes. Thank you so much, Boyki. You have been a great support so far. At the end, I really wish you all a Merry Christmas and a Happy New Year. May 2015 be a very happy year for you all on both personal and trading levels. Thank you so much, and I think we have a few minutes to take questions if you have any. Thank you again.